All right, today we're putting two American manufacturing titans in the ring. In one corner, you've got A.O. Smith, the undisputed king of water heaters, and in the other, Whirlpool, the giant of home appliances. Now, they're both facing the exact same headwinds: tariffs, rising costs, you name it. But, and this is the interesting part, their strategies for winning couldn't be more different. So let's break it down.
So let me just throw this out there. Imagine you've got two companies. For every single dollar of product they sell, one of them gets to keep almost 40 cents. The other one, just 15 cents. Now, who are you putting your money on? I mean, based on that one number, the answer seems like a no-brainer, doesn't it? But as you'll see, the real story is, well, it's a lot juicier than that.
All right, let's get right into it. Round 1, the profit squeeze.
So to really understand this, we've got to look at something called gross margin. And hey, don't let the term scare you. Forget all the accounting jargon. It's actually super simple. It's just asking, for every dollar of stuff you sell, how many cents are left after you pay for the steel, the plastic, and the factory workers who put it all together. It tells you how profitable the actual making of the thing is.
And when you put these two side by side, whoa, the difference is just staggering. A.O. Smith is pulling in a gross margin of nearly 39%. That's just incredibly healthy. Whirlpool, on the other hand, is at about 15%. Look, this isn't just a small gap, it's a massive chasm. So the million-dollar question is, why?
Well, A.O. Smith has this absolutely brilliant business model, and it's all built around one thing: urgency. I mean, think about it. When's the last time your water heater broke? You're not exactly scrolling through ads looking for a President's Day sale, right? No, you've got cold showers, you need a new one, like yesterday. And get this, over 60% of their sales are these emergency replacements. That gives them incredible pricing power. On top of that, their contracts are written so that when steel costs go up, guess who pays for it? The customer. It's a genius way to protect their profits.
Now, Whirlpool is living in a completely different world. The home appliance market, it's a total street fight. It's brutal. You know how it is? We, as consumers, we wait for those big holiday sales. There's always a competitor ready to slash prices. All that promotional pressure means Whirlpool just doesn't have the same power to set their prices. And you can see it right there. Their margins get squeezed big time.
So, okay, A.O. Smith pretty much dominated that round on profitability, no question. But here's the thing. Profit on an income statement isn't the same thing as cold, hard cash in your bank account. So for round 2, let's follow the money and look at the cash machine. Yeah, we're going to be looking at a metric called free cash flow conversion. And honestly, this might be my favorite metric of all time, because it just cuts through all the accounting nonsense. It answers one very, very important question. Of all that profit a company claims it made, how much of it actually turned into spendable cash? You've probably heard the saying, profit is an opinion, cash is a fact. And it's so true.
And this is where A.O. Smith just becomes unbelievable. They reported over $500 million in profit, and they generated the exact same amount in real cash, 100% conversion rate. Think about that. Every single dollar of profit they put on paper actually landed in their bank account. That's just wild.
Okay, now let's flip over to Whirlpool. They reported a pretty decent profit, right? $318 million. But they only managed to turn that into $81 million of actual free cash flow. That's a conversion rate of, what, around 25%? So you have to ask, where on earth did the other 75% of that so-called profit vanish to?
The answer really comes down to their different business cycles. A.O. Smith is what we call a short cycle business. They make a water heater, they sell it, they get paid. Boom, boom, boom. Cash comes in fast. Whirlpool, though, they have to tie up massive amounts of cash in something called working capital. The easiest way to think about it is this. It's money that's literally stuck. It's sitting in warehouses full of dishwashers and refrigerators, all waiting for the next big Memorial Day sale. And as long as it's sitting there, it's cash that Whirlpool can't use for anything else.
Okay, so at this point, this is looking like a total blowout, right? A.O. Smith has better margins, way better cash flow. They look unstoppable. But not so fast, because in our final round, we're going to look at a completely different kind of strength. It's not about making money, it's about building a fortress to survive the chaos.
So you're probably thinking, okay, this is a knockout victory for A.O. Smith. And on paper, it looks that way. But hold on, because in the world we live in now, the rules of the game are changing. And sometimes being resilient is even more important than being profitable. And this, right here, is where Whirlpool's quiet, long-term strategy starts to look incredibly smart. You see, while a lot of companies were chasing cheaper manufacturing all over the globe, Whirlpool was busy building a defensive moat,
right here in their own backyard. Just look at this. 96% of the steel that Whirlpool uses in its American factories comes from American steelmakers. Now, just pause and think about what that really means for a second. When there are trade wars, when tariffs get slapped on imported goods, or when global shipping gets completely messed up, Whirlpool is basically shielded from all that drama. They're insulated.
This is their local-for-local strategy in action, and it's brilliant. 80% of the appliances they sell here in the US are actually made here in the US. And look, this is way more than just a patriotic marketing slogan. It's a rock-solid strategic hedge against risk. In a world that seems to get more unpredictable by the day, having a supply chain this resilient, well, that's a massive, massive advantage.
So after 3 rounds of this clash of the titans, what's the final verdict? Let's lay out the scorecard.
Okay, so if we're looking at the pure financial metrics, the gross margin, the free cash flow conversion, A.O. Smith is the clear winner, hands down. It's an absolute machine when it comes to turning parts into profit and profit into cash. But then you look at that third category, supply chain resilience, and the tables turn. Whirlpool's 96% domestic steel sourcing gives it this incredible defensive strength. So here's how it all shakes out. We don't have one winner. We have 2 very different kinds of champions. A.O. Smith is the undisputed industry cost leader. They are masters of efficiency and profitability. And Whirlpool, they're the operational resilience champion. They've built a fortress designed to withstand just about any global storm. It's fascinating. They've optimized for 2 completely different versions of success.
And it's not just us saying this. The market sees this clear as day. I love this quote from an HDIN Research analyst note. It says, A.O. Smith is a premium compounder, basically a reliable, high-quality machine for growing your money. Whirlpool, on the other hand, trades at a transformation discount. That's Wall Street's way of saying investors aren't totally sold yet on whether this resilient strategy is going to pay off in the long run. And it really leaves us with a huge, fascinating question for the next decade. What's ultimately more valuable, pure, unadulterated profit, or unshakable resilience?
Of course, what we've talked about today is really just scratching the surface of our latest deep dive on these 2 companies.
So if you want to really get into the weeds, see all the data, and get the full competitive analysis, you can get access to our in-depth report. Just reach out to us at HDIN Research. The email is right there on your screen. Thanks so much for tuning in.